morning, everyone. Welcome to a special video that we thought we'd make on the back of the news that a Bitcoin ETF has been approved in the US. I want to talk a little bit more about how this ETF might be constructed, how it differs to the Grayscale Bitcoin fund that's already been trading for several years, and some things to look out for when it comes to this ETF construction. What are you actually buying? What are the costs incurred for trading this ETF and holding this ETF over the long term? So let's dive right in. So first of all, the ETF that is created will be an ETF that is exposed to Bitcoin futures, not physical Bitcoin. That is to say, ProShares, the creator of this ETF, will be buying and selling Bitcoin futures to determine the value of their ETF product, not physical Bitcoin. Now, there's a difference, right? So you can either buy physical Bitcoin underlying and create a product whose price is dependent on the physical underlying, as you do with Grayscale. Grayscale actually buy Bitcoin physically to back up their fund, or you can buy a future. Now, a future is a derivative, and you're never actually getting exposed directly to the physical. You don't own the physical underlying when you're trading a futures. So what is a futures? A futures is essentially a contract where you agree to buy or sell an underlying asset at a given date in the future, but you agree on the price today. So if we look at the current, let's say look at the December future for Bitcoin, if you were to buy a December future in Bitcoin, you would agree to receive Bitcoin at the end of December in return for paying $62,700, which you would also pay at the end of December once Bitcoin has been received. Now, that's good. It means that you don't have to front the capital right now. You only have to pay in December, which makes overall capital usage in the now much more efficient. You also know what your cash flow is going to be in December, which allows you to plan better as a company or as an institution. Allows you to plan and secure future expected cost flow. And overall, this is relatively speaking, it's a good thing, and there are pros of trading these sort of products. Now, historically, the futures curves come from the commodities market, where a user of metals or a user of oil or jet fuel, if you're an airline, for example, you're always planning ahead. So you're not looking to buy jet fuel with a view to have it arrive today. You kind of plan what your flights are going to be over the next 12 months, what your jet fuel costs and usage is going to be as a result of those planned flights. And so you're buying futures contract for the delivery of jet fuel in 6 months, 9 months, etc. Now, what that means is that the further into the future that you look to receive an asset or a commodity, the seller who sells you the futures contract has costs associated with that, be they storage costs, insurance costs, eventual transportation costs, and all these things add up. And that's why normally in a market you see a futures curve actually being upward sloping, which is what we call a contango. What that means is that there is a premium associated for having something delivered in the future. Now, before we digress too much, the pros of trading the Bitcoin ETF will be as follows. So first of all, it's a regulated product on a regulated exchange. So you're trading. It's very easy to trade. You're not having to set up an account with various cryptocurrency institution brokerages or exchanges. You don't have to go through the hassle of buying your own wallet to store your crypto assets on, which for a lot of people, it can be a hassle. It can be a daunting task, having that responsibility on your own shoulders. In this case, all you're doing is buying a product that gives you exposure to to Bitcoin without actually having to go through that entire tedious process of doing all that yourself. As I said, you're trading a regulated product on a regulated exchange, so there is some sort of investor protection that you get, and you're not at risk of, I guess, being hacked or having your assets stolen. So again, it's good for a lot of people who don't have much experience of trading in the crypto markets. This is a relatively easy way of getting exposure to the price volatility. Now, there are some cons as well. First of all, you have the fact that an ETF only trades during the market hours of the exchange on which it trades. So this ETF will likely be on NASDAQ, maybe on the New York Stock Exchange. But what that means is that you're only going to be able to trade this ETF for 8 hours every day on weekdays, whereas Bitcoin markets trade 24/7. If there's a huge price move over a weekend, if it's to the downside and you're holding shares in this ETF, you're not able really to do much about it. You're going to wake up on a Monday morning and the value of your ETF is going to open at a much lower level. You won't have been able to sell it over the weekend. Now, you don't own any Bitcoin yourself. Now, we said that might be a pro, but I think it's a pro if you're maybe a retail investor. But at the end of the day, you're not able to actually sell the ETF shares at any given moment to somebody else bilaterally on the internet in exchange for another product. You're literally bound to selling the shares of this ETF back to your broker, off whom you bought them, and that kind of defeats the point really of a decentralized network where you can move value whenever you want, wherever you are, at any given time. You have this counterparty risk to your broker, which is what we're trying to avoid, what the entire kind of Bitcoin industry is trying to avoid. Now, finally, and this is especially true of markets that trade in this contango that we highlighted just now, is that you have a hidden cost of roll return. Now, what do I mean by that? Say you have this ETF and you're looking to buy $1 million, or you have $1 million to invest, you stick it into the ETF. Now, because you're buying the future, you're gonna, let's say we're in September, you're gonna buy the closest to deliver future, which is the October future, which is trading at $61,000. So if you invest $1 million, ETF provider will go into the market, will buy 16.39 futures, which is just 1 million divided by 61,000, and so essentially you're holding 16 futures of the October futures, which is okay, which is good. Now we roll forward. We as time goes on, we get to the end of October, when the October futures is going to expire. We don't want to let the futures contract expire, because if you do, then you have to take reception of the underlying asset, or you have to settle the difference in cash. But the ETF is trying to offer continuous exposure. So what you have to do is then sell these October futures and buy the November futures. So what we're doing is selling the October futures at $61,000, assuming that the price hasn't changed and assuming that this contango curve is unchanged. At the same time, you're buying the November future, which is at 61,200. So you've sold 16.39 futures, you're buying back 16.33, and immediately you can see where the cost is incurred, right? All of a sudden, the investment that was previously able to buy you a larger amount of exposure, buy you a larger amount of futures, that is suddenly decreased. Your purchasing power has gone down by 0.33%. Now, you might be thinking, okay, that's not too bad, but let's go a month further on into the future again. Say we get to the end of November. Again, the ETF provider rolls the futures contracts, i.e., they sell November and buy December. Let's look at how it is now. So you're selling the November future at 61,200. You're buying the December future at 62,700. So again, your $1 million investment is only able to buy 15.94 futures. Now that's a difference of $1,500 between these two. So your purchasing power has gone down by 2.45%. Now, multiply that over 12 months, and suddenly your purchasing power over a year decreases by, just a touch more, a touch, above 25%. So even if the Bitcoin price has gone up by 50% over a year, the value of the ETF, or the price appreciation of the ETF, might have only gone up by 25%. And it can be even worse the steeper this contango curve is. Of course, there is a chance that this contango curve flattens a bit and becomes, these costs decrease. But as long as there is a contango in the futures markets and on Bitcoin over the long term, historically, there has always been this upward sloping forward curve. As long as there is an upward sloping forward curve, you will incur this cost every month, or your purchasing power will decrease every month, depending on what the difference is between the nearest to deliver future and the following ones after that. So, to conclude, there are benefits of trading an ETF. It's easy to trade. You're trading on a regulated exchange. You're not at risk of being hacked. But there are also some cons, and these are you're limited to traditional market trading hours. You don't actually own Bitcoin, which you can't use for, which in turn can't be used for trading anything bilaterally or buying something bilaterally. You have this continued counterparty risk to your broker, and you have this cost of return, or this kind of decrease in purchasing power as the longer you hold this ETF. That on top of the 0.95% you're paying on an annual basis. So bear that in mind. I hope that makes sense. If you have any questions, please don't hesitate to get in touch. And yeah, take care.